Today we will analyze Community Healthcare with ticker symbol CHCT. This company was founded in 2014 and has about $500 million of market cap. It currently provides about 10% dividend yield, so let's see if it's worth investing in it. Starting with its business model, 37% of its revenue comes from renting out medical office buildings, and the other two-thirds comes from renting out various types of hospital buildings. Moving on to its historical performance. Since its IPO in 2015, CHCT had a great run up to 2021, increasing more than 2.5 times. However, since then, the stock price has fallen pretty significantly and now trades at below IPO price. And over the past 5 years, it has lagged behind other REITs in the US. And I found three main reasons of this underperformance. And I will point these out as we analyze these REITs. Unlike the dramatic swings in the stock price, CHCT's revenue had constantly increased at high double digits. However, it experienced a slowdown in recent years. Moreover, its EBITDA margin stayed above 60% in the past, but it is falling in recent years. And this recent decrease in profit is the first main cause of CHCT's underperformance. So why did the profit decrease exactly? In March 2023, Timothy Wallace, the former CEO and founder of CHCT, passed away in an accident. This unfortunate event increased the uncertainties regarding CHCT's future leadership and strategic direction because the company is still so young and has a small size. So this news had a negative impact in the stock price and also decreased its profit because this event accelerated amortization of deferred compensation, which lowered the company's profit margin. But looking forward, this one-time event will not be repeated, so it won't be a problem for new investors. Looking at the historical dividend, the company continuously increased its dividend at more than 2% per year. Now, let's take a look at key operating metrics. As we can see here, the company continuously increased its properties, and at the same time, it maintained high occupancy rates. And currently, it sits at 91.3% of occupancy. And the REIT has 315 tenants, which is well diversified, except that the top two tenants has a pretty high share of revenue at about 16%. And this tenant risk is the second key reason for CHCT's underperformance in recent years. That is, Genesis Care, which was one of the top tenants, went bankrupt in 2023. So let's look at this case study more carefully. Genesis Care is based in Australia and provides cancer services worldwide. In 2016, China Resources Group and Macquarie Capital acquired control of this company through an LBO investment. But it filed for Chapter 11 bankruptcy in 2023, and the cause of the fall is the following. First, in 2019, the company aggressively invested in 21st Century Oncology and other hospital assets in the US very aggressively, utilizing high levels of debt because at the time, the cost of borrowing was very low. However, after this acquisition spree, COVID hit was in 2020 and 21, which negatively impacted operations. And afterwards, in 2022, interest rate hikes put a very high burden to this company. So after declaring bankruptcy, the company went through 5 steps. First is debt to equity swap, so the equity holders are wiped out, and the US business was separated. And in order to pay down the debt, the company went through a quick asset sales, and new set of owners, including Oaktree and Bain Capital, took control of the company. And as of February 2024, the company is out of bankruptcy. So this issue is mostly resolved. So how did this event impact CHCT? First of all, Genesis contributed about 4% of revenue in 2022. And after the bankruptcy, 7 out of the 9 properties are re-rented to new owners. And 2 of the 9 are looking for new renters, but they only contribute about 0.6% of CHCT's revenue. So this tenant risk definitely damaged CHCT's performance in the past, but at least in the Genesis Care case, the issue is almost resolved. And now, moving on to other operating checklists, the lease expiration schedule looks pretty well spread out. And in terms of the location of properties, they are well spread out across the United States. Moving on to the dividend safety, the payout ratio is currently 84%, which is not very low, but at the same time, it's definitely a manageable level. Overall, the operation looks fine, except for the tenant risk, which we'll have to discuss further in the future. And now, let's move on to the financial risks. First of all, the debt increased constantly in the past, but this was to support the increase in assets, so this is a reasonable case. However, in terms of the debt to EBITDA multiple, current 7.5 times is higher than the industry average of 6.2 times. Also, the interest coverage ratio is constantly falling recently and currently is below 3 times. Next, CHCT's effective interest rate is at about 5%. This is not extremely high, but at the same time, it's definitely higher than its peers, which usually sits at about 4%. The good news regarding debt is that its maturity schedule is well into the future. So until 2028, CHCT does not have to worry about paying back the debt. So financial risks are mostly at about neutral stage. However, there is a hidden risk that we'll need to discuss. That is, CHCT not only rents out the buildings, but also provides loan to its tenants. This loan amount is shown here in orange color. It's smaller compared to the total asset size, but recently there has been some issue with these loans. Most notably, in the second quarter of 2024, a hospital operator which rents out 6 buildings was not able to pay its rent and interest. And the three main cause is first, the company expanded during COVID period, and the interest rate hike in 2022, as well as the change in management in 2023 negatively impacted the business. As a result, CHCT had to realize $11 million of credit loss, which is about 20% of FFO. So this was a pretty significant loss. So after the second quarter earnings, CHCT's stock price tanked. So let's take a step back and look at the pros and cons of this business. First pro is its 10% dividend yield, which is definitely high. And second, as we saw in previous videos, the healthcare sector's macro is pretty positive. And third, the negative impacts that happened were one-time events, so they won't be repeated in the future, at least from the exact same players. Some negatives were that first, the revenue has stopped growing, and also, there could be other tenant risks which are hidden and will negatively impact the company's performance in the future. But going back to the three positives, the second positive, which was the positive healthcare macro, could raise some eyebrows. Because although the industry is expected to have good macro because of population aging, as well as the increase in outpatient treatments, but as we saw in CHCT's case, some tenants are not able to continue its business. And there are three main reasons for these short-term challenges. First, is because everyone knew that the dynamic of healthcare is good, there is oversupply in the market right now. And second, the COVID definitely put pressure in this sector for about 2 years, which would have been fine except that these companies were overly levered as well as the interest rate hike in 2022 made it much harder to pay down their debt. So this short-term risk is definitely there, but I continue to analyze this healthcare sector because of the long-term opportunity, which comes from the change in population dynamic. And now finally, let's look at the valuation. Starting with its dividend yield, current 9.8% definitely checked the boxes for my investment goal of 6.5% of dividend yield. On top of this, CHCT increased its revenue for more than 2% per year in the past. So if I consider this, we can expect more than 12% of return per year from investing in these REITs. And looking at historical multiples, current 15.6 times is not necessarily the lowest, but overall, it's in a good range to invest in. However, there are hidden risks on top of these numbers. First, CHCT was able to increase its revenue because it acquired assets by raising capital through selling equities and debt. This was fine when the stock price increased for several years since IPO. However, because of the negative events that I explained in this report, the stock price is currently falling and trades at price below IPO. This means that it will be difficult to increase dividend through issuing more shares, and because of the company's current difficulties, it will be difficult to raise debt as well. So we cannot blindly expect that the dividend will increase in the future. So here are the three scenarios that I ran. And on top of this, if we consider additional risk that can be revealed from hospital tenants that are struggling, we can expect about 7 to 11% of dividend yield through investing in CHCT at current price. Okay, so that sums up my analysis of CHCT. And please let me know if there are other REITs that you would like me to analyze. Thanks, guys.